So a weak bond market is bullish for gold. It's not bearish. Look at what the Fed is doing. Don't pay attention to what Warsh is saying. I better sell my gold so I can get 5% on a 10-year Treasury. The market confirms my interpretation, because look at what happened to the price of gold. The opinion of the FOMC was that inflation is a problem, it's too high, and it's more likely to go up. They were looking for excuses, who they blame the inflation on. Some of them were blaming it on AI. Stock market doesn't cause inflation. AI doesn't cause inflation. The Federal Reserve causes inflation. So basically, the government running big deficits and buying treasuries is running an accommodative, highly accommodative fiscal policy, which is complicating the Fed's job of trying to run a tight money policy. QE is coming. In fact, the Fed is already doing QE. It's just not an official program, but they are going to have to ramp it up. And clearly, they're not going to be able to hike rates. It would put monetary policy at odds with fiscal policy. What the Treasury announced was that they were now going to be doubling their buyback of long-term treasuries. These are treasury bonds, 20, 30-year maturities. They were buying $2 billion every time they bought, and now they're going to buy $4 billion. Treasuries they're going to buy. And as soon as the announcement came out, the price of gold spiked. In fact, I didn't even know the announcement. I had to look it up. I saw gold moving, saw Bitcoin moving, I saw stock futures moving, and I had to look up the news. I wasn't even sure, because remember, I'm here out on vacation, and so I had to just go online and try to figure out what was going on. But a lot of people were calling this QE or QE light. This is not QE. The Fed did not announce anything. This is the Treasury. The Treasury is going to be buying more long-term bonds. But unlike the Fed, the Treasury doesn't have the printing press and can't just create money out of thin air to buy long-term bonds. So where does it get the money? It sells more short-term bonds. So it's financing the debt. It's buying back the previously issued longer-term debt and replacing it with shorter-term debt. Now, why are they doing this? Because this is a very reckless thing to do. First of all, if you look at the average coupon on the debt right now, the longer duration debt, the debt that's going out from 10 years or longer, the average coupon is 3.44%.
The Treasury just doubled its long-term bond purchases, and that may signal desperation rather than strength. As Peter Schiff points out here, replacing 3.44% long-term debt with roughly 4% short-term borrowing increases refinancing risk. The government is effectively betting that future conditions will somehow become easier. That shifts risk from today's bond market into tomorrow's taxpayer burden. Next, Peter Schiff exposes why this buyback could quietly make the debt problem even more dangerous.
Why would you want to refinance that? 30-year rates now we're at 5.3. Now they moved down just below 5.2. I think I looked, it was 5.18, and the 10-year is down at 4.6 something. But if you've got all this long-term debt locked up at 3.44, why the hell would you want to refinance that with Treasury bills at 4%? I mean, that'd be like somebody having a straight mortgage. Maybe they got 25 years left on it, and you got a 3.5% mortgage. Why the hell would you want to pay that off by borrowing more money and getting a 1-year ARM? Nobody would be dumb enough to do that except our government. Now, they're not doing it just because they're dumb. They're doing it because they're scared. This is really a panic move on the part of the government. It's a Hail Mary to try to stop long-term interest rates from rising by announcing that the government is going to buy the bonds that everybody else is selling. Remember, they're basically stepping in front of this trade because the market doesn't want treasuries. The market is selling treasuries, and now the U.S. government has decided that it's going to use taxpayer money, basically, to buy the treasuries that everybody else is selling. Clearly, it's not a smart financial move. So why are they doing it? They are trying to slow down the rate of increase in long-term bonds. But the trade-off is they're shortening the average maturity on the national debt, which is already just under 6 years. And it's going to get a lot shorter as this program expands because it's not going to be enough. This is just the opening bid, right? This is not the end of it. This is more like the beginning.
The real danger is not today's interest rate. It is the maturity wall the government is deliberately creating. According to Peter Schiff, refinancing cheap long-term debt into costlier short-term bills exposes Washington whenever rates rise. That makes future budgets increasingly sensitive to monetary policy, while officials claim they are stabilizing markets. For investors, this means today's intervention can become tomorrow's inflationary pressure and currency risk. Next, Peter Schiff reveals why this opening move may be only the beginning of a much larger Treasury intervention.
And I've been saying this for a while, that the Treasury was going to up their buybacks. But this also is, going to make it much harder for the Fed to raise short-term interest rates, because now the government itself is more vulnerable to the increase because it's having to refinance this short-term debt. So why would they do that? Why would the government trade in long-term debt that they've already locked in these low yields to expose itself to all of this risk? And it's all expedience. They're kicking the can down the road. They're trying to trade some relief from the short-term pain for long-term pain. But the long-term pain is going to come when all this short-term debt matures and it has to be rolled over, or because the Fed is cognizant of that vulnerability, it doesn't raise interest rates. In fact, when people are calling this, again, quantitative easing, it's not, because the Fed is not doing the buying. So the money supply isn't expanding as a result of this, but it will, because as the U.S. government is selling these short-term treasuries, who's going to buy those? I think the Fed is going to end up buying them by actually launching a QE program. And in fact, because the Treasury is not going to be buying enough long-term bonds to stop the rise, I think they'll slow it down a bit, but it's not going to stop it. The Fed is ultimately going to come join the party. So QE is coming. In fact, the Fed is already doing QE. It's just not an official program, but they are going to have to ramp it up. And clearly, they're not going to be able to hike rates. It would put monetary policy at odds with fiscal policy. The fiscal policy is stimulative. They're trying to lower long-term rates.
The Treasury's solution to rising yields could be creating a trap that eventually forces the Fed's hand. What Peter Schiff is highlighting is the mismatch between shorter debt funding and the government's need for low rates. If Washington becomes increasingly exposed to refinancing costs, the Fed faces enormous pressure to accommodate rather than tighten. That could shift the burden toward inflation, weaker purchasing power, and real asset demand. Next, Peter Schiff unravels the contradiction that could force the Fed back toward QE.
So basically, the government running big deficits and buying treasuries is running an accommodative, highly accommodative fiscal policy, which is complicating the Fed's job of trying to run a tight money policy, because the Fed is worried about inflation being too high. Well, now the Treasury is making the Fed's job harder by putting even more upward pressure on inflation. So as soon as, the news is out and people are talking about, whether it's QE or it's more like Operation Twist. That was, if you remember that, and that happened after they did QE, the first QE. I think it was between QE2 and QE3, they did Operation Twist. And if you remember at the time, I was calling it Operation Screw, because they were screwing over the country, because the Fed was selling short-term debt to buy long-term debt to move long-term interest rates down, because the markets were more sensitive to long-term rates and the mortgage market was more sensitive. So this is like an Operation Twist, only it's the U.S. Treasury that's doing it, not the Fed. But again, this is just a peek at what is going to happen. The government is already panicking. They're going to trade inflation to try to slow down interest rates. Again, I said I agree with Kevin Warsh. Inflation is a choice. He acted as if the Fed won't choose inflation. I said from the beginning, of course it's going to choose inflation, because it can't choose the opposite. And the fact that the Treasury is already moving in this direction is pretty clear that the Fed is going to be moving in the same direction.
The government says it wants lower borrowing costs, yet its own strategy may be making inflation harder to defeat. Peter Schiff's argument suggests Treasury intervention is effectively pressuring the Fed toward accommodation, even while officials publicly emphasize inflation control. That contradiction matters because suppressing yields does not eliminate debt. It redistributes the cost through future inflation and purchasing power erosion. For savers, the danger is being trapped between negative real returns and rising asset prices. Next, Peter Schiff exposes why this policy resembles Operation Twist, but with a far more dangerous incentive.
Anyway, I want to get back to the Fed because later in the day today, after we got this surprise announcement, of course, I don't know why anybody is surprised. I mean, I wasn't surprised. I mean, I've been waiting for this. I mean, I know the box that the government is in. They just can't allow rates to rise. And so they're doing whatever they can to push back against the free market. But the free market wants higher interest rates for a reason. And the reason is we have too much debt. And the way you stop too much debt is by making it more expensive to borrow. What the government wants to do is prevent that so they can keep borrowing more. But all that does is make the eventual crisis that much worse because the bubble gets much bigger than it would have had the market popped it sooner. In fact, popped it a long time ago if it wasn't for government intervention into the market. But anyway, when the FOMC minutes were announced at 2 o'clock, they were actually more hawkish than the markets had expected. And had it not been for the morning announcement, the stock market might have tanked today. The bond market might have gone down. Yields might have gone up because nobody wanted to cut rates. Everybody was talking about hiking rates. You had the dissenters who wanted to hike rates right away. But the opinion of the FOMC was that inflation is a problem. It's too high. And it's more likely to go up. Now, they were looking for excuses or who they blame the inflation on. Some of them were blaming it on AI. Stock market doesn't cause inflation. AI doesn't cause inflation. The Federal Reserve causes inflation.
The Fed sounded hawkish, yet markets barely reacted because Treasury policy had already changed the battlefield. According to Peter Schiff, the FOMC minutes showed officials still worried about inflation and even considered immediate hikes, but Treasury intervention softened the market response. That creates a dangerous disconnect between monetary rhetoric and fiscal reality. Investors hear restraint, while government financing becomes increasingly rate sensitive. If that gap widens, gold can become the hedge against policy credibility itself. Next, Peter Schiff reveals why the inflation debate completely misses the deficit driving it.
The government helps the Federal Reserve create inflation by running these big deficits. So the fact that we've got a $40 trillion national debt and that it's rising sharply, because when I did my podcast a few days ago, we were still about 80 billion away or 100 billion, but we moved up quickly. And this is what's causing inflation. And again, it's not the war that's causing inflation. It's the way we pay for the war. It's the deficits that we're running. We didn't raise taxes to pay for the war. We didn't cut other spending to free up resources for the war. We just spent. And so bigger deficits mean more inflation. But the Fed never talks about it. They never talk about these big deficits as a cause of inflation. They never talk about all the money supply and the money they're printing, although they are talking about the balance sheet. And they're talking about a need to shrink the balance sheet. Well, how are they going to do that when the Fed is doing Operation Twist? What, they're going to try to sell back the bonds that the U.S. government is buying? They're not going to be negating what Treasury is doing. Obviously, they're going to coordinate. They're going to work together. So there's no way. But had it not been for this announcement, this could have been a big problem for the markets. In fact, I don't know, maybe the Treasury knew that these FOMC minutes were going to be hawkish, and they had to take the sting out of it before it had a chance to affect the market. So the markets basically shrugged it off. The odds of a rate hike went down, even though the FOMC minutes were more hawkish than expected because of the action of the U.S. Treasury. Now, the market confirms my interpretation, because look at what happened to the price of gold. So yesterday, gold dropped about $80, closed near the lows of the day. That was probably the worst day gold's had in at least a month, if not more. And silver was down. Today, gold rallied about $185.
A $40 trillion debt burden changes the inflation equation. because every rate hike now carries a fiscal cost. What Peter Schiff is highlighting is the feedback loop between deficits, debt servicing, and monetary accommodation. Higher rates increase government costs, while tighter policy becomes harder to sustain. The result is a market where gold can rise precisely because bonds are weakening, not despite it. Next, Peter Schiff exposes the dramatic gold reversal that turned this policy contradiction into a market signal.
Closed above 4,500. In fact, last night, gold was down about 20 bucks. So it had a $200 intraday rally. Huge. And a reversal day, technically, because today we took out yesterday's low in gold and then closed way above yesterday's high. So technical reversal, we're now about 13% above the low for gold. Gold bottomed out just below 4,000. If you remember, I was pounding the table on this podcast saying, look, 4,000, that's the low. You gotta buy that. And here we are now above 4,500. Silver had a big day as well. It closed above $66 an ounce. Let me see where it is right now. I'm recording this at night. It's about 9:30 at night. And well, silver's actually down about 18 cents now, 66.71. So yeah, well above 66. In fact, I think that earlier tonight it might have gotten above 67. Gold's retreating, it's down about 20 bucks, but it's still trading above 4,500. So a very significant day for gold and silver. The mining stocks were on fire today. A lot of these stocks are up 7, 8, 9, 10, 11, 12%. I think the GDXJ 8%. Both of those indexes in the last month are up close to 40%. And they're up for the exact reason I said they were going to be up. Gold went down, gold stocks went down because people were fooled by the Kevin Warsh show, by, the whole, dog and pony. Oh yeah, we're going to be tough on inflation. Inflation's going back down to 2%. Like everybody was talking, oh, he's this new sheriff in town.
Gold's $200 intraday reversal matters more than another headline claiming inflation is under control. Peter Schiff's argument suggests a sharp move above $4,500 reflected investors recognizing that Treasury weakness and policy intervention can reinforce demand for hard assets. Silver above $66 and miners approaching 40% monthly gains amplify that signal. For wealth preservation investors, the lesson is simple. Bond stress can become a precious metals catalyst rather than a reason to flee them. Next, Peter Schiff reveals why the Fed's tough talk never matched its actual behavior.
He's Paul Volcker reincarnate, and I was saying, no way, the markets are wrong. He's not going to do this. It's all talk. And I kept saying, look at what the Fed is doing. Don't pay attention to what Warsh is saying. Look at money supply. Look at the balance sheet. Look at the fact that they're not hiking. All of the tough talk didn't jive with the fact that they were sitting on their hands and doing nothing. And now the Treasury is making it even harder for the Fed to fight inflation. In fact, they're putting a lot more pressure to create inflation because as the Treasury continues to shorten the maturity of the national debt, whenever the Fed raises interest rates, it inflicts that much more damage on the budget. The budget deficit goes up because now it costs more to service that debt. And so as the Fed tries to fight inflation, it actually sows the seeds for more inflation because now these bigger deficits, how the government going to finance them? The Fed's going to ultimately have to finance them. That's why I kept saying the fall in the bond market. People were worried about rising bond yields being bearish for gold and silver. And I kept saying they're not, they're bullish. Because the rising bond yields are going to force QE. The rising bond yields are going to weaken the economy. They're going to cause bigger budget deficits. And in fact, the reason that bond yields were rising was because of inflation. And it wasn't that higher bond yields were going to be some kind of competition for gold. Like, oh, I better sell my gold so I can get 5% on a 10-year treasury. No. It was just another reason to sell your treasuries because treasury prices are falling. When yields are rising on treasuries, that means the price of treasuries is going down. That means if you own treasuries, you are losing. So what do you want to do? You want to get rid of your treasuries and you want to buy gold. So a weak bond market is bullish for gold. It's not bearish.
The biggest warning may be that rising treasury yields are becoming bullish for gold instead of competing with it. This is where Peter Schiff's thesis shifts from inflation to debt mechanics. Higher yields increase government interest costs, worsening deficits, and potentially strengthening pressure for monetary accommodation. That creates an unusual loop where the policy meant to restore stability can eventually undermine the currency's purchasing power.